Welcome back to Bonnie's Life, where we cut through the noise and get straight to the facts that actually move markets. If you're tired of the mainstream media telling you what to think while the smart money quietly positions itself, you're in the right place. Today, we are diving deep into the crypto markets, analyzing the data for April 17th, 2026. We're going to break down exactly what's happening for our short-term scalpers, our mid-term swing traders, and our long-term diamond hands. And trust me, with the data we're seeing today, you cannot afford to be flying blind. Hit that like button, subscribe if you haven't already, and let's get into it. Let's start by looking at the big picture. The total cryptocurrency market capitalization took a massive 20.4% hit in the first quarter of 2026, dropping from its October 2025 peak of $4.1 trillion down to a floor of $2.4 trillion. But here is the interesting part. We are currently seeing a fragile stabilization. As of this morning, Bitcoin is trading right around $75,747. That is a solid jump from yesterday, but still down about 10% from where we were exactly 1 year ago. The market is currently testing a massive resistance wall between $75,000 and $76,000. There is literally $450 million in sell orders sitting right there, waiting to cap this rally. It's a high-stakes tug-of-war, and the tension is palpable. Now, let's talk about the Fear and Greed Index, because sentiment is everything. Right now, the index is sitting at 23, which is extreme fear. But wait, some other indicators are showing a neutral to slightly greedy stance. Why the discrepancy? Because the retail market is terrified, while the institutional players are quietly accumulating. We've seen 65,000 Bitcoin flow into short-term holder exchange wallets within 24 hours when we hit $75,000. Large deposits surged from below 10% to over 40% of the total. The whales are making their moves while the retail traders are panic selling. This is classic market psychology, and if you understand it, you can profit from it. Let's look at the derivatives market because that's where the real leverage is. Total open interest has edged up to $126.68 billion, and total market volume has surged 28% to $225.8 billion. But here is the kicker. Liquidations have skyrocketed 140% to $529 million in just 24 hours. We are seeing a mild short squeeze, with short liquidations slightly exceeding longs. And get this, Bitcoin funding rates have been negative for 46 consecutive days. According to K33 research, the last 2 times we saw this pattern, it was followed by massive sharp rallies. The market is coiled like a spring, and the pressure is building. We cannot ignore the global macroeconomic events that are driving this volatility. The geopolitical situation in the Middle East has been the primary catalyst for the recent crash. The blockade of the Strait of Hormuz sent WTI crude oil spiking to $104 a barrel, draining global liquidity and putting massive pressure on Bitcoin miners. In fact, public miners liquidated over 32,000 Bitcoin in Q1. That's $2.3 billion worth of selling pressure. But here is the good news. The Israel-Lebanon ceasefire took effect yesterday, and Iran has declared the Strait of Hormuz open. Oil prices are slumping, and risk appetite is returning. This is a massive fundamental shift that the mainstream media is barely covering. And then there is the Federal Reserve. The market was expecting rate cuts, but the Fed is likely to hold rates steady at 3.5% to 3.75% through June. However, with the recent ceasefire news, the expectations for a rate cut by December 2026 have jumped to 60%. A weakening US dollar, with the DXY index falling for 7 consecutive days toward pre-war levels, is incredibly bullish for crypto. When the dollar weakens, global liquidity flows into risk-on assets like Bitcoin. Former Fed Chair Walsh is even warning of hyperinflation, which is music to the ears of Bitcoin bulls targeting $125,000. Let's break down the technical setups, starting with our short-term traders. If you are scalping or day trading, you need to watch the $75,000 to $75,500 resistance zone like a hawk. This is the 100-day moving average and a major supply shelf. If we get a decisive 4-hour or daily close above $75,500 with strong volume, That is your trigger to go long, targeting the $80,000 to $80,600 level. However, if we reject hard of $76,000, look for a short entry targeting the immediate support at $70,540. Keep your stop losses tight because volatility is going to be wild. For the midterm swing traders, your focus should be on the broader structural levels. The market found a solid floor between $62,000 and $65,000 during the Q1 crash. As long as we hold above the key pivot at $70,741 on a weekly closing basis, the structural trend remains bullish. Your strategy here is to buy the dips into the low $70,000, anticipating a breakout above $80,000 as the macroeconomic conditions improve and the ETF inflows continue. Speaking of which, spot Bitcoin ETFs just recorded their third consecutive day of net inflows, pulling in $26 million yesterday. The institutional bid is still there. And finally, for the long-term investors, the diamond hands. Your strategy remains unchanged, dollar cost average, and ignore the short-term noise. The fundamental thesis for Bitcoin has never been stronger. We have a weakening dollar, institutional adoption via ETFs, and a finite supply that just went through a halving. The Q1 crash was a necessary deleveraging event, shaking out the weak hands and resetting the market structure. As VanEck analysts pointed out, this was not a death spiral, it was a healthy correction. Keep stacking those sets, move your coins to cold storage, and let the macroeconomic cycle play out. To wrap this up, the crypto market is at a critical inflection point. We have a massive technical resistance wall colliding with improving macroeconomic fundamentals and aggressive institutional accumulation. Whether you are trading the 5-minute chart or holding for the next decade, the data is clear. The smart money is positioning for a breakout. Don't let the mainstream media's fear-mongering shake you out of your positions. Stick to your strategy, manage your risk, and trade the data, not the emotions. Thank you for tuning in to Bonnie's Life. Make sure to like, subscribe, and leave a comment below with your price targets for the end of the month. I'll see you in the next episode. Stay sharp, stay profitable. But wait, there is more to this story than just Bitcoin. We need to talk about the altcoin market because that is where the real asymmetric returns are generated. The total market capitalization of altcoins, excluding Bitcoin, is currently sitting at around $700 billion. That is down about 40% from the peak of $1.16 trillion we saw back in December 2024. The altcoin season indicator is currently flashing a neutral 37 out of 100. This tells us that the broader altcoin market is subdued, waiting for Bitcoin to make a decisive move. However, there are pockets of incredible strength that you need to be aware of. Let's look at Ethereum. Ether is currently trading between $2,358 and $2,454 with a market cap of roughly $233 billion. It has suffered a 30% year-to-date drawdown, but the underlying metrics are screaming bullish. Ethereum open interest has jumped 26% recently, and over the past 7 weeks, it has risen 45%. This is a massive accumulation of derivatives positioning. For Ethereum to lead an altcoin recovery, it must reclaim the $2,586 level, which is the 10-day exponential moving average. If it breaks that level, we could see a violent rotation of capital from Bitcoin into Ethereum and the broader altcoin ecosystem. And then there is Solana. Solana is currently trading around $90.31, and it is leading the growth in open interest among the major cryptocurrencies. In just 24 hours, the number of active contracts in Solana futures increased by 11% to 5.53 billion a sol. That is the highest level since mid-March. The funding rates are positive, and the cumulative volume delta is bullish. This indicates aggressive buying pressure and a strong appetite for bullish positioning. If you are a mid-term trader, Solana is showing the kind of relative strength that you want to be exposed to. We also need to discuss XRP, which has quietly become the top weekly performer among the major cryptocurrencies. It is currently trading around $1.50, up 6.4% on the week, outpacing Bitcoin, Ethereum, and Solana. This is a significant development, especially considering the ongoing regulatory clarity surrounding the asset. If XRP can maintain this momentum and break through its overhead resistance, it could trigger a massive short squeeze of its own. Now, let's dive deeper into the macroeconomic factors because you cannot trade crypto in a vacuum. The correlation between Bitcoin and traditional financial markets, particularly the energy sector, has reached an all-time high in 2026. The recent spike in WTI crude oil to $104 a barrel was a direct headwind for crypto. High energy costs drain global liquidity, and more importantly, they increase the break-even price for Bitcoin miners. When the cost to mine a Bitcoin exceeds the market price, miners are forced to sell their reserves to cover operational costs. This is exactly what happened in Q1, with public miners dumping $2.3 billion worth of Bitcoin onto the market. But the narrative is shifting. The Israel-Lebanon ceasefire and the reopening of the Strait of Hormuz have caused oil prices to slump. This is a massive relief valve for the crypto market. Lower energy costs mean less selling pressure from miners and more liquidity available for risk-on assets. This is a fundamental catalyst that the market is just beginning to price in. Furthermore, we need to look at the stablecoin market, which acts as the plumbing for the entire crypto ecosystem. Despite the 20% drawdown in total market cap during Q1, the stablecoin sector remained incredibly resilient at $309.9 billion. This tells us that capital is not leaving the crypto ecosystem. It is simply moving to the sidelines, waiting for the right opportunity to redeploy. Interestingly, we saw a slight decline in Tether's market cap, while Circle's USDC increased by 2.4%. This indicates a flight to regulated quality during the crash, as institutional investors prefer the transparency and compliance of USDC. Let's talk about the Federal Reserve again because their policy decisions are the ultimate driver of global liquidity. The market is currently pricing in a 60% probability of a rate cut by December 2026. If the Fed does pivot and begin cutting rates, it will unleash a flood of liquidity into the financial system. Historically, Bitcoin and the broader crypto market have performed exceptionally well in a low interest rate environment. The combination of a weakening US dollar, lower energy costs, and potential rate cuts creates a perfect macroeconomic storm for a massive crypto bull run. So, how do we trade this? Let's refine our strategies based on this deeper analysis. For the short-term traders, the volatility is your friend. The $529 million in liquidations over the past 24 hours shows that the market is highly reactive. You need to be watching the order book and the liquidation heat maps. The $450 million sell wall between $75,000 and $76,000 is the key battleground. If we see a sudden spike in buying volume that chews through that wall, you want to be long, riding the momentum of the short squeeze. Conversely, if we see a sharp rejection and a cascade of long liquidations, you want to be short, targeting the $70,540 support level. Use tight stop losses and do not over-leverage. For the mid-term swing traders, patience is key. You are looking for structural confirmation. The weekly close above the $70,741 pivot is crucial. If we maintain that level, the trend is your friend. You should be looking to accumulate strong altcoins like Solana and Ethereum on any significant dips, anticipating a rotation of capital once Bitcoin breaks its all-time highs. Keep an eye on the altcoin season indicator. When it starts moving from neutral to greedy, that is your signal to increase your altcoin exposure. For the long-term investors, the data is validating your thesis. The institutional accumulation is undeniable. The spot Bitcoin ETFs are consistently drawing inflows and the whales are buying the fear. The macroeconomic headwinds that caused the Q1 crash are beginning to dissipate. The halving has reduced the new supply of Bitcoin and the demand is only increasing. Your strategy is simple: hold your spot positions, continue to dollar cost average, and do not get shaken out by the short-term volatility. The smart money is playing the long game, and you should be too. In conclusion, the crypto market in April 2026 is a complex ecosystem driven by a confluence of technical, fundamental, and macroeconomic factors. The mainstream media will try to sell you fear, but the data tells a different story. We are seeing a healthy deleveraging event, aggressive institutional accumulation, and a shifting macroeconomic landscape that is highly favorable for risk-on assets. Whether you are a short-term scalper, a mid-term swing trader, or a long-term diamond hand, there are incredible opportunities in this market if you know where to look. Thank you for joining me on this deep dive into the crypto markets. Here at Bonnie's Life, we are committed to providing you with the most accurate data-driven analysis available. We don't deal in hype, we deal in facts. If you found this analysis valuable, please hit that like button, subscribe to the channel, and share this video with anyone who needs to hear the truth about the crypto markets. Leave a comment below with your thoughts on the current market structure and your price targets for the end of the year. I read every single comment and I love hearing from you guys. Until next time, stay sharp, stay disciplined, and stay profitable. This is Bonnie, signing off.